Good afternoon, everyone, and a warm welcome to the Q3 FY19 earnings call for Apar Industries. I will start the call with just running over some of the key industry highlights, then review each of the segment's financial performance, and post that open the floor up for questions. So the quarter has seen Apar deliver a fairly strong growth in terms of revenues. We had a 41% growth for the quarter over the previous period. This growth in terms of revenues has actually been seen across all three segments, with the cable business delivering the highest growth percentage. We have seen that the domestic demand has remained quite robust. Export markets for our specialty oils and cables, particularly in the Middle East and the African region, have been a bit muted, but sales from the domestic region have more than made up for the drop in the export sales or in the overseas markets. I would also like to cover a few highlights in the transmission and distribution sector to just give you an overview of what is happening in the sector from our perspective. So in the last quarter, the T&D orders have come in at approximately 13,000 crores. And this is similar to what was announced in Q3 of FY18. There has been significant progress in increasing electricity access. AC transmission lines capacity has been increased to 3.9 lakh kilometers by December 2018. 100% household electrification has been completed in 25 states by the end of the last quarter under the Saubhagya scheme, and under the Integrated Power Development Scheme, that is IPDS, 48% of physical progress has been achieved till the end of November 2018, which is the last set of numbers that is available in terms of the system strengthening projects. In terms of the DISCOM reforms, under the Uday scheme, that has achieved a reduction in book losses of the 32 participating states and union territories to 15,049 crores in FY18 from 51,480 crores, which was 2 years ago, prior to the scheme being announced. There is a 42 paisa per kilowatt reduction in ACS ARR gap, which has now reduced to about 17 paise per kilowatt hour. The ATC losses have declined from 20.7% in FY16 to 18.7% in FY18. So there's about a 2% drop. Challenges still remain in achieving the target which was set for March 19 for the ATC loss reduction, which was supposed to be at about 15%. So we are about 3.7% off that mark. And mainly this is due to inadequate tariff hikes. There has also been a very slow implementation of the smart metering. And the incremental rise in open access transactions have also reduced. The outstanding from some of the state government departments have actually gone up in the last few months. So overall there has been improvement, but there are some of these areas where things are still falling a little bit behind. In terms of railway electrification, there were tenders of over 5,000 crores which were awarded in the third quarter of FY19, and from the information that we have gathered, over 18,500 crores in the 9-month period of FY19. Power Grid has also achieved about 49% of its targeted annual capex of 25,000 crores by the end of the first half. There is a definite revival in the wind sector. As of December 18, bids for setting up of the wind projects of 8.4 gigawatts has been finalized through Solar Energy Corporation of India and NTPC. Government will soon be auctioning transmission contracts of over 8,000 crores connecting these renewable energy projects into the grid. As we go into the next couple of years, we are likely to see a slowdown in the capex for the ultra high voltage transmission systems, but This will be substituted with a very strong demand for evacuation from the non-conventional energy projects and other smaller energy projects. So therefore, we expect that it will continue to have a positive impact on all the three business segments that we have. Given those general comments, I would now like to cover a little bit more specifically in terms of Apar's financial performance. In Q3 FY19, consolidated revenues came in at 2,120 crores for the quarter, which is up 41% year-on-year, driven by growth in all the three divisions. EBITDA came in at 115 crores, which is up 17% year-on-year. There was a fairly steep and unexpected fall in the price of crude and its derivatives. And this was actually against our expectation, given the fact that the Iran sanctions have been pretty strongly imposed. Our expectation actually was that oil would start moving up. It was already moving up prior to the sanctions coming and hitting in there, indicating that there was an upward bias. But instead of that, there was a very steep fall that took place post 4th of November. This resulted in us actually narrowing our margins across all the oil product lines in December, as we had reasonably high inventory and we wanted a slightly higher inventory at the end of October to just weather what we were expecting to be an increase in the marketplace. So this has, even though we had a good October and November, our profitability in December was as a consequence impacted. If you look at the interest costs have been higher because there is an increase in the LIBOR rate from about 1.93% to approximately 3.03% year on year. So the interest costs have increased as a consequence of that. Profit after tax came in at 35 crores, which is down 12% year on year. This includes a non-cash impacting translation loss of 4.18 crores from our Hamriyah operations. Even though the Hamriyah business is actually a fully dollar hedged business where we buy in US dollars and sell all products in US dollars, the inventory which is held as it comes into the consolidated balance sheet picks up a translation loss, and in this particular quarter it has been reasonably significant at about 4.18, but this is a non-cash charge which is there. If you look at the 9-month period, which is FY19, our consolidated revenue increased 36% year on year to reach 5,504 crores, and the EBITDA has increased 18% to reach 337 crores. Profit after tax came in at 92 crores. With a PAT margin of about 1.7%. More specifically on the conductor business, the conductor business in terms of revenues grew 65% year on year to reach 1,052 crores for the quarter. Volumes have increased by 13% to reach 47,234 metric tons. The EBITDA per metric ton post forex adjustment came in at 8,269 rupees per ton, which is up 18% year on year, with a higher share of copper conductors and rods. The EBITDA was partially impacted by
Ladies and gentlemen, the line for the management has got disconnected. Please stay connected while we reconnect the management. Ladies and gentlemen, thank you for patiently holding. We now have the line for the management reconnected. Over to you, sir.
Yeah. Due apologies. I think the line from the exchange actually had some trouble. I will just restart on the conductor business because I'm not exactly sure where I dropped off. So conductor business grew 65% year on year to reach 1,052 crores in FY19. The volumes increased 13% year on year to reach 47,234 metric tons. The EBITDA per metric ton came in at 8,269 rupees, up 18% year on year. The EBITDA was partially impacted by some costs which were higher than expected in terms of some of the manufacturing costs related with our Jharsuguda facility, where there was a problem with the power for most of the quarter. That's now been settled and restored. Also, the HEC revenue contribution in the last quarter came at its lowest level in several quarters, which is at about 8%. In terms of the Q3 FY19, the order book has reached an all-time high of 3,226 crores, which is up 111% year on year and 20% higher over the previous quarter. New intake in the quarter came in at 1,568 crores, which is up 13% year on year. So a lot of this has come in from both the domestic and the export markets. Even though the competition for conventional conductors has been a little bit on the higher side, new orders from the railways for copper conductors came in at 616 crores. This is in line with the higher outlay of the electrification of the railways. The high efficiency conductor saw steady demand coming in from the South Asian countries, but there were really no new orders that had come in from the domestic side. This has clearly been a disappointment, given that there are a lot of tenders which have already been opened and are still to be finalized. And there is a number of tenders which are still sitting in the form of latent demand for these high efficiency conductors. In the 9-month period FY19, the conductor revenue increased 55% year on year to reach 2,568 crores. The EBITDA per metric ton post forex adjustment increased 14% to reach 10,159 crores. Coming to the specialty oils revenue, that has reached 727 crores in Q3, which is up 28% over the previous year in terms of volume growth. In terms of value growth, volumes were up 9% year on year at 1,15,765 KL. The auto and industrial sub-segment lubes delivered good growth levels. On the auto side, we grew by 24% year on year, and in the industrial side, we grew 21% year on year. This sub-segment has contributed 13% by volume and 20% by value to the specialty oil segments. The volumes for transformer oil were up 7%, and for white oils were up 6%. If you look at the EBITDA performance per KL after forex adjustment, it came in at 4,042 rupees per KL, which is substantially higher than what it was in Q2 FY19, which was only 1,312 rupees. However, it is 11% down from what it was in the previous year period, and this is largely due to, as I explained, a sudden drop in the price of crude, etc., which led to price corrections ahead of a reduction in raw materials, especially in the third month of the quarter, which is the month of December. Looking at the 9-month period, the specialty oils revenue has increased 23% year on year to reach 1,934 crores. The EBITDA per KL post forex adjustment has come in at 2,853 rupees. On the cable business, The cable business has delivered a revenue growth of 47% year-on-year to 420 crores. And within that, we've seen the elastomeric cables grow 22% year-on-year with the revival in the wind sector and additional outlays coming in from the railways. The power cable side grew by 29% year-on-year. Telecom cables were up 192% as we ended up executing orders for BBNL and some of the other telcos. The EBITDA margin post forex adjustment was at 9.8% in Q3 FY18. If you now look at the 9-month period, the cable revenues have increased 51% year-on-year to reach 1,176 crores. In 9 months, we have exceeded the annual revenue of the previous year. The EBITDA post forex adjustment increased 67% year-on-year to 120 crores. And the EBITDA margin for the 9-month period came in at 10.2%. As we enter the fourth quarter of FY19, we are reasonably comfortable with what we see ahead. The demand remains steady for all segments in the cables division, for industrial and automotive oils as well as transformer oil. The order book in the conductor business is good, and there are a lot of prospects in both the North and Latin American markets, which have not been traditional markets for us. The railway electrification projects are also continuing. We are quite optimistic that this latent demand for the high efficiency conductors that has been eluding us for the last few quarters will get converted into orders in the next few months to come. Our new CTC, which is a copper transposed conductor line, which will be used for the transformer industry for the core winding of the transformers, is expected to be commissioned by April 19. We also expect improved profitability in the oil division with a more stable outlook on oil prices in Q4. In conclusion, we are reasonably optimistic about the future irrespective of the developments that happen in the forthcoming elections as such. So with this, I would like to come to the end of my comments. I would also like to thank everyone for joining our conference call and apologize for the outage that we had in between, and now throw open the floor for questions.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is on the line of Pankaj Tibrewal from Kotak Mutual Fund. Please go ahead.
Yeah, good afternoon, Kushal. Good afternoon, Chaitanya.
Yeah, good afternoon.
Yeah. What we have been observing for last few quarters is that the top line has been strong for most of the period. But somehow the cost management or the interest cost is surprising us on the negative side. And the only worrying point is that the interest cost is now running at 200 crores per annualized number. Can you just help us understand how's the debt position? Where do you see that number coming down? Because just 1% LIBOR increase may not be explaining the entire interest cost increase. Has the working capital deteriorated a bit out there? Because whatever you guys have been doing very brilliantly over the top line somehow is getting negated by the cost management and the interest cost. Thanks.
Okay. The debt, the overall long-term debt is about 172 crores, and short-term debt, which comprise of PCFC, is about 73 crores. And plus we are having the LC financing actually, wherein the 1530 crores is the LIBOR-based finance and 686 crores is the rupee finance. As we have said earlier, actually the LIBOR interest has increased from 1.9 to 3.03. So almost 60% increase is there in the LIBOR interest. Plus, if you see, the overall revenue has grown by 36%. So when there is a growth in revenue, either on account of there is a volume increase across all the businesses, plus there is a value increase because of the commodity prices. So overall increase is 36%. So because of this, the interest cost has increased. And from interest cost, as we have said, the open period forex, which is now coming to about 19 crores, needs to be knocked off actually, because that we adjust in EBITDA. So the overall interest cost after adjusting this open period forex will be about 123 crores.
So has the open LC amount gone up substantially over the last year period? Or
Yes, it has gone up actually.
how much?
It used to be about 1800-1900 crores proportionately, but it is proportionate to the business.
So actually, Pankaj, is Kushal here. There is no deterioration that has happened in the working capital number of days.
Okay.
So if you run across the receivables that are there in the businesses individually, they're pretty much in the same level, plus minus a day. And similarly, the net working capital also hasn't changed substantially. On the LIBOR front, as Mr. Devadkar said, there is this difference of about 1.1 or 1.2%. And proportionate to the,
60%.
there has been a increase that has happened in proportion to the revenue. Where the problem has happened, so if you see the cable business actually the EBITDA has gone up even with the higher sales. The conductor business has had a higher EBITDA per metric ton. The spoiler to the party has really been the oil business, especially in the first half. And there has been some improvement in quarter 3 compared to quarter 1 and 2. But last year, quarter 3 and quarter 4 were relatively very good for the oil business. So that's where actually that has been a bit of a spoiler. If you also look specifically at some of the more profitable pieces of the oil business, it's really been driven by us increase in sales of the automotive and industrial products in the past. However, the price increases which we've been able to make in the market have been lagging behind. We mentioned that in the previous calls also, both in the terms of the OEM segment as well as on the retail side for us. So those price increases are now gone through, because in the case of OEMs it's formula based. So you'll probably find in the fourth quarter the higher price with a lower cost. And then post that, then it should start setting into a more stable cycle, because the increase happens once in a quarter. So the pricing which is there, for example, of July, August, September forms the basis of what will happen on 1st of January.
Okay. And just for my understanding, what was the debtor days on your conductor business and your inventory days on conductor business?
Conductor business debtor days was 107 days, and inventory is about 54 days.
And payables would be?
Payables will be about maybe 130. But that includes the LC payables, huh?
So that would be 30 days interest free and balance then interest, or?
Yes. 30 days interest free and balance interest.
Okay, fair enough. Just it's running at 200 crores per annualized number now, but the profitability hasn't seen the same improvement as the top line. So it's hurting our bottom line significantly.
The 9-month period has been 123 crores. Huh?
So another 40
so
maybe.
It will be somewhere in the vicinity of
165.
Yeah.
Okay. Reported number says 140.
That is correct, but because we have to adjust the open period forex, which we adjust in the EBITDA margin.
Okay. Fair. Thanks a lot.
Yeah.
Thank you.
Okay, right. Thank you.
Thank you. The next question is from the line of Praticha Daftari from Equitas Investments. Please go ahead.
Good afternoon, sir. So, if you could elaborate a little on, the raw material cost. Last 2 quarters, we are seeing it to be around 80% of the sales. So, do we expect this to be in this range? And also, you mentioned about some increase in power cost at Jharsuguda. So, if you could elaborate further that what was the impact in this quarter? Apart from that, what kind of execution period do we have for, planned for the current order book? Yeah, these are my questions.
Current order book is close to about 10.5 months actually, as far as conductor is concerned.
Okay.
As far as this Lapanga plant is concerned, because of bureaucracy, we had not got the grid connection, and we had to generate the power based on the diesel generator. End of December, we got the permission. So that impact is about 350 rupees per metric ton. So that much improvement will be there going forward from January onwards. As far as the raw material cost is concerned, we have to look at different businesses actually. Overall,
so it's difficult to capture it based on a percentage of top line because a lot of it depends on the LME or the but roughly speaking, if depending on the mix of the product that comes in, our expectation is that as you move into 2019. You see, in the case of our conductor business, our high efficiency conductor business has come down to 8%, which was already at 13%. And the entire last financial year was also close to that number of 13%. So, so that actually does have a big impact in terms of
of
the conductor side. In the case of our oil business, our product, the value should actually improve as we go forward, with the margins on the industrial and automotive expanding. On the cable side, we see that, pretty much at this level. Our guidance for the year was anywhere between 10.25 and 10.5. And we are at 10.2 for these 9 months. Looking at the order book which we have, which we'll execute in Q4, it pretty much looks like we'll be there between the 10.25 and 10.5%.
Okay. And in quarter 3, what was the contribution to revenue from railway orders?
So, we actually have both the cable and conductor segment, which have significant presence in railways. So, if you see the value in terms of
189 crores.
It was about 189 crores in Q3 from the conductor side. I don't have handy the number from the cable side, but I can tell you that it was about 100% higher in this quarter compared to the same period previous year. So in fact, one of the biggest growth drivers has been the railways. Also, the electrification is resulting in this complete stoppage of diesel locomotives being built. So you will have to now substitute the diesel locomotives with electric locomotives. So the work that's going on the electric locomotive side is also running at a fairly high level. An approximate number that we have for the railways is about 110 crores is what we've executed this year versus about 62 crores that we executed in the same period previous year for the railways. 9 months I'm talking about. So you see that the business is up, almost 80% in the year-on-year period.
Okay. And if you could just update us about the GST refunds. The last time we talked, in the call, you had said about 44 crores are stuck with GST refunds. So where do we stand right now with those?
GST refunds have now become reasonable actually. The GST refunds at the end of December were about 17 crores. Earlier that number at one point of time it was 100 crores, later on it was 80 crores, then 55 crores, and now it is reasonable at 17 crores. Plus the pre-import condition which they had put, because of which these refunds were getting accumulated, that condition also they have removed with effect from 1st January, and they have said this has been removed till 31st March. Hopefully they will extend that period also. But now that refunds should further go down actually.
Okay. Also, I just couldn't get I couldn't hear you properly. So if you could mention your LC credit which is linked to LIBOR, the number.
That was 1530 crores.
15, and non-LIBOR base?
Non-LIBOR base is 686 crores.
All right. Okay. Thank you, sir.
You're welcome.
Thank you. The next question is from the line of Girish Raj from Quest Investment. Please go ahead.
Thank you. Good numbers on conductor side. So when I look at your new order inflow, excluding the railway also, it comes to around 3,367,000 crores. when I look at the market, there is a subdued sentiment in terms of the transmission side. But our numbers suggest good. Kushal bhai, can you give your view as to what is happening in terms of international and domestic when we see that TBCB players, private players are under pressure?
So you're correct that the transmission in the country domestic market is generally down, but that is more so for the interstate transmission business. The distribution business and the sub-transmission actually is fairly compensating the drop in the interstate transmission. And with regard to Apar, we are, as you know, doing a lot of exports also. So that has helped us. And this new business of copper conductor, then some of the optical fiber, ground wire, OPGW. So all these things put together have helped us to increase our order book. And also we have done some high efficiency conductors, which actually went down somewhat. But this is another avenue which is not linked to the new lines. It is more for the reconductoring cases. So in times to come, our drivers, growth drivers may be other than the interstate business.
See, if we actually go back and look at, some of our comments in the previous earnings calls, the conductor business, a few years ago was very dependent on just conventional, overhead conductors.
Okay.
We now have basically 5 areas from where, business is coming in, 4 of which are running, and the 5th, which is the CTC that will start in April. So we have the conventional conductors, and we have the high efficiency conductors. Then we've brought in the copper conductor line, which from the railways, and we have increased our alloy sales, of the PA rods and things which go into specialty fixtures, for electric hardware, etc. So, and besides these 4, there's also the OPGW, which actually is a little bit smaller in terms of its value, but is another diversification that exists. So the whole conductor pie, the pie has been, broad-based. And in FY20, you'll start seeing higher and higher percentage of all this coming in compared to the conventional conductors. And it's also being reflected in this current order book to some extent, except for HEC, where we haven't physically received the order. We are L1 on a number of jobs, and there's a whole lot of new tenders which have been published but not opened yet.
So of this 3,226 crores of order book, majority would be conventional and HEC, or how does it break up?
HEC is about 255 crores.
Okay.
And this copper conductors,
600
and order received. 686 crore is copper conductors.
Okay.
And 255, as I said, is HEC conductor.
Okay.
And balance will be this
conventional
conductor, domestic and export both.
Okay. Also, I would appreciate if you can share your view on exports, because that is a market which is driving our order book, I would guess so, because domestic is under pressure. And which are the countries that is driving?
Yeah. So basically, even like in India, the same phenomena is worldwide, where a lot of renewable energy is coming in. So that is actually driving the worldwide transmission and distribution business, where the generation is happening in some part, and they have to create new grids to feed into the main grid. So this is one of the sort of drivers. Secondly is some of the countries which are traditionally underdeveloped, or they now have better sort of political situation, stability. So even the World Bank and other financial agencies are supporting the governments to, with a lot of more infrastructure projects. So we are seeing that as another major driver in some of those African countries. Then also in some countries where they are developed, but they had not really upgraded their systems for many decades. So there also we see that they are now trying to make their system more robust and strengthening their respective grids.
So what I'm getting is you are getting growth from the market expansion and geographic expansion, is it?
Yes, correct. Absolutely right. So even the Americas, including Latin America, we are seeing some growth in Europe also. Of course, as I explained, in some of these developed countries, it's more to do with renewable energy grids, that kind of work. While in Africa, in some Asian countries, it's more new grids completely with conventional products also.
Domestic sentiment would remain subdued for some time?
Overall, I would say it will not be too much down. There are different type of client and different type of business. So earlier we used to have Power Grid as our main client doing interstate work. Now we'll have a lot of EPC parties doing intrastate, and also private sector, boot companies, developers. So there's a different sort of requirement nowadays in the marketplace. Even some HEC, OPGW. So I won't say overall the sentiment is down, but it's of a different nature.
The nature of the beast is different. As Chaitanya said here, that previously you had these ultra, and I mentioned that in the opening comments, you had a lot of ultra high voltage lines, 765, 800 kV, etc. So that there's very little of new lines coming in. It's mostly execution of the existing lines which are there, which may last for another couple years. But a lot of new business is being generated from the non-conventional energy sources as well as within the state. So and this phenomena is a worldwide phenomena, as Chaitanya said. We are seeing opportunity coming up in countries which we didn't export to so much in the past. This includes Scandinavia. There's demand in Australia coming up, Canada, North America, etc. So it's the ball game has changed a little bit. Fortunately, our manufacturing is very flexible.
Okay.
And in fact, in some of these cases, there's high efficiency conductors going into some of these developed countries. So we are, sort of pitching on that. So if that comes through, then, obviously we have higher value addition as we go forward.
Okay, thank you very much.
Thank you. The next question is on the line of Rukun Tarachandani from Kotak Asset Management Company. Please go ahead.
Hi. As per the numbers that you just shared, it appears that copper conductors is about 20% of the order book. So is this a high margin product similar to the HEC conductors?
So it is in between conventional and the HEC in terms of margins.
Okay. And HEC, the order book is less than 10% of the overall order book. So what gives us the confidence that, we might see a better contribution from this segment going forward?
Yeah. So as Kushal explained in our opening remarks, that there is a latent demand. So already the lines have been identified by the respective customers, but either due to bureaucracy or funds not being allocated this year for these various projects, these demands have got postponed because the government was trying to push for more of the connection to each of the villages, and a lot of more work was happening on the distribution side. But as the urbanization mode is increasing, definitely the power to the respective cities or state capitals have to also go up. So a lot of strengthening of the grid has to happen to feed the powers to the cities. So that is why this latent demand exists, and these lines have been identified. A lot of these lines are today running at more than their existing capacity, and it is actually not a very healthy, safe kind of operation. So they will have to be upgraded in times to come.
In fact, it's, in some cases, there's a little bit of a political issue because, when you reconductor, you have to take shutdowns, for periods of time so that the reconducting can be done on those lines. And that is a little bit politically inconvenient given the impending election. So that also has been a slight contributory factor. So our sense is that, there's no real room to postpone this. And it's just a matter of time before which it comes. It's a bit frustrating and disappointing that, it's from a high of 13%, it's come down to 8%, when the trend was expected to go to 20% of our revenues. But I think we just have to wait a little bit more patiently for a few months, and it's going to fall in place. In the meantime, other countries like Nepal and particularly Bangladesh have completely standardized on these high efficiency conductors, especially in difficult terrains. So the demand from there is continuing to come, but obviously we will see higher profitability in the domestic market as compared to an export market with all the logistics and other costs which are involved. So we see this only as a postponement, but not something which will not happen.
Understood. And on the cable side, do you share an order book, or what kind of visibility you have on the revenues, and within that on the elastomeric cables as well?
So we don't really have the cycle of execution is a lot faster than in the case of conductors, which is a much more long cycle business. So even though we have about 700 crores worth of pending orders, it's not reflective of a judgment on how much the business will end up doing. The elastomeric business actually is growing, as I said earlier. It's grown 22% in terms of volume, and we continue to see growth there because the drivers for it are the wind energy is just coming in after having a lull for about 2 years. So the main drivers for elastomeric business are wind, solar wire paneling, defense ships, and the largest segment emerging now is the railways, where it is used both for coach as well as locomotive wiring. So our expectation is that next year also we'll see about a 20% growth in the in the elastomeric segment.
Understood. And one final question: you said that for oil segment, December was bad, considering you had some high-priced inventory of raw materials. How was that? How do you see that situation in the current quarter? Is that high-priced inventory largely out, or that the situation continues?
So we will have a problem in the month of January, which is just the past month, as most of that hangover gets sold out. So you'll start seeing better margins from February onwards. The more important thing is that it seems like the outlook for both the currency as well as for the crude, the band in which it will probably operate will be a lot tighter than it was in 2017. The 2018. You won't see such wild swings taking place. Now, no one can actually predict it, to perfection. But if that does happen, then our oil business profitability will be similar to what it was in 2017, when we ended up having more stability on that front. And the benefits of our growth in the automotive industrial side have not manifested. The moment we are able to catch up on the cycle of the inflation, which will happen in the fourth quarter, you will start seeing an improvement taking place on margins.
Understood. Thank you.
Thank you. The next question is from the line of Saurabh Patwa from HDFC Mutual Fund. Please go ahead.
Thank you, sir, for taking my question. I just wanted if you could just throw more light on the volume segmental volumes within conductor. This may help us to understand how the blended realizations would have improved and and some outlook on the same going forward.
Actually, we are not giving the volumes; we are giving values only.
I understand, sir. So basically, just because our realizations have improved dramatically in last one and a half years, right? So a part of it would be because of the copper conductors, which would have higher realization. So just
copper conductor is about 13% of revenue, and stainless is about 10% of revenue, and rod is about 10% of revenue. So here you see about 33% coming from the other than the conventional conductors. And copper is almost three times the aluminum.
Yeah.
That is why you are seeing the realization improving, mainly on account of copper, plus the stainless realization is also higher.
Okay.
And how would be the margin profile for these products? Would be as you said,
HTLS is the highest margin.
Okay.
And copper and
copper would be somewhere in between.
Actually, copper is in between, and then the last one is the conventional. The rod is between copper and conventional.
Okay. Fair enough, sir. Thanks a lot.
Thank you. The next question is from the line of Maulik Patel from Equirus Securities. Please go ahead.
Thanks for the opportunity. A couple of questions. In cable side, if you can elaborate the breakup of the revenue between the power, telecom, and the elastomer for the 9 months, that would be helpful. Approximate.
So the growth percentages are out, but if you look at the segmental increases or the values which are there, so approximately for the 9-month period, about 1100 crores is the total sale that has happened. 1131 crores actually. So elasto is around 265, optical fiber is about 185. And XLP is around 685.
Okay. And in the same category, if I want to
approximately 20, you can say 23 to 25% is elasto, 15-16% is OFC, and around 60-62% is the XLP.
Okay. And from a margin perspective, elastomer will be the highest, right? Followed by the OFC and then the power?
Absolutely.
Okay. Second question is on again on the conductor side. And so again we have, I think, the ramp up in the copper conductor is much better than what we initially thought about, and also it's all now reflecting in your order book. Though you have some specific, the HFC, HEC was it conductor has been down, but from a guidance perspective at EBITDA per ton, what could be the number for the coming years? I'm not looking for a near term, though there could be a volatility because of the raw material prices, because the way your mix is now going to change, also copper is increasing. So what could be that guidance which we can look forward?
So our hope is that we can increase our quantities of the more specialty products with the better value addition. And definitely the latent demand, as I mentioned, is there on the HEC. Copper, we are seeing the real demand on the railway side. Also some of the specialty alloy products and some of the other new products like the CTC, which will come out in April. So keeping this in mind, we see the value addition EBITDA improving in the business. But we have to sort of, be a little cognizant that we do see some changes in the marketplace from time to time,
Sure. It's really difficult, Maulik, it is really difficult at this stage to tell you a number. But we can only say the trend. The trend will be upward.
Okay,
because
fine.
Of the increased product mix of higher EBITDA products.
See, our idea is to use our common facilities and to debottleneck what of the areas are for making the more value-added products. So that is our basic strategy.
Okay. And the last question is again, I think in the first question there was an interest component, was that right? Now historically what we have observed, and one, I think the rupee volatility along with the commodity price volatility increase your interest expense because the hedging cost goes up. This time also the LIBOR has also moved up as mentioned in the comments. And also the revenue base has also increased, so obviously the working capital and the hedging cost has gone up. From the purely the number perspective, what we are currently around 170-180 CR of revenue. 170-180 CR of an interest expense. Will it go up or go down, just from a trend perspective?
See, with the revenue going up, it will go up actually.
Okay.
The revenue going up, it will go up, but the LIBOR, we are told that the LIBOR is likely to go down actually. In years to come, now the LIBOR will not increase. That is what is the trend which we have been indicating.
So I think, Maulik, at the end of the day, I think the measure that we would see as a management is the ratio of interest to the value addition that we drive in the business.
Sure.
What has happened is that the figure looks worse in the 9 months period because the oil business actually has been running at an EBITDA per KL which is only 60% of what it did in the previous year.
Correct.
Moment that changes and comes back to a more normal level, you will see a big jump that's happening on the overall value addition of the company. The interest per se is not going to reduce because customers are pushing for longer days of payment and they are ready to open LCs, etc. But they say, okay, you give me 30 days extra or 60 days extra on an LC versus on open credit. And given the current scenario, as a management, we would prefer a confirmed instrument which is irrevocable and without recourse, as opposed to open payment terms. Even if we have to give a few more days of credit, just to manage the cash flow. So the key thing that we have here is, that is not something that is going to change very much. But what hopefully we will be able to achieve in FY20, and all the blocks are pretty much lined up for that, is that the mix of the business will be able to improve the value addition.
EBITDA.
So, whereas it's difficult to tell you what the EBITDA will be exactly next year for the conductor business, we've designed the product mix for it to get to 12,000 rupees per ton. So when you have the HEC there, when you have the copper in there, the PA rods, business, etc., and all of that contributing to over 40% of our revenues, then we should be edging towards 12,000 per ton.
Okay, I got it. Thank you.
Thank you. The next question is from the line of Nimish Shah from MK Investment. Please go ahead.
Yeah, thanks for the opportunity. Sir, if you could just explain what is this translation loss at the Umbria plant?
See, the functional currency in Umbria is US dollar actually. We maintain the books in US dollar. The translation loss comes in when you convert that to rupees actually.
Okay. So this is booked loss or?
This is just a paper loss actually because all the operations are operated in US dollar only, no?
Okay.
So what has happened here and why the loss is a little bit more prominent is that, as it's a dollar business, but as you consolidate it gets translated into rupees, the inventory level that we were holding as at the end of the quarter was relatively high.
Understood.
So as a consequence, the translation loss becomes more...
And inventory has to be translated at the quarter end rate, whereas the purchases are to be booked at the average rate of the quarter.
Okay. So is this 4 crore loss included in the EBITDA number?
It is included in the EBITDA number.
Okay.
It is included.
It's from EBITDA, it's coming all the way down through to PAT because there is no taxation effect, in that jurisdiction.
Okay.
So if you take the cash impact as opposed to the book impact, then it would go up by that 4.9 crores.
So is that the reason why the tax rate is higher this quarter?
Tax rate, yes, correct.
Okay. And any guidance on the tax rate for the full year?
Tax rate is almost full rate is there actually. Indian rate actually. As far as this subsidiary is concerned, this is not having any tax. So if it makes profit, then the overall tax rate will go down. If it makes loss, then the tax rate will look to be higher.
Okay. And sir, on the 9-month basis, what will be the HEC contribution to the overall country?
10%.
10%. Okay. Thank you.
Thank you. The next question is from the line of Shan from Edelweiss. Please go ahead.
Hi, good evening, sir. Shraddha from Edelweiss.
Yeah, good evening.
Hi. I think this was asked earlier, but just wanted to reiterate, in conductors, while you said with all the measures that we are taking and as HEC and all pick up, we'll be going eventually towards 12,000 EBITDA per ton. But as of now, looking at the run rate, I think somewhere we have indicated that we will be somewhere in the 10,000 range only, right, for the year? Because last quarter we were talking about somewhere upwards of 11,000. So that looks difficult in the current scenario, right?
In the current scenario, it does, primarily from the fact that, the high efficiency conductors, even if the orders start coming in, there's very little time for execution. and the execution is also a function of, getting the, as I mentioned earlier, the line outages.
Right.
It's a little bit politically sensitive because, if you have long line outages, then it's equivalent to not having power, for those households. So we see a little bit of a, that's why I said that it's a little disappointing that, some of this business got postponed. But it's clear that this business is out there, and as Chaitanya had mentioned earlier in the call, many of the lines which had been identified as priority for changing are running at dangerously high levels of transmission. They should not be transmitting that much power on those lines. So it's very likely that some of this stuff will fructify. So we are, at this point in time, we have no other option but to sort of just patiently wait and be on top of the customers to make sure that when the opportunity comes up, we are ready to execute.
Sure. And also, you twice indicated that there's slowdown of new lines and the ultra-high HVDC and all. So, I mean, is it that it's like topping out for us as an opportunity and hence the product mix will now be, mixture of all these newer opportunities like copper conductors and our conventional conductors?
So in India, to some extent what you said is correct, although as I explained earlier, some of the 765 kV business which was there in a big way will be replaced by low voltage classes, 220, 132 kV per lines. But elsewhere in the world, there will be definitely the normal demand, So that is also driven by a lot of new work happening on the renewable energy side.
So yes, Shraddha, thing is that you will have a slowdown happening on the 765 kV and 800 kV in terms of new awards. Having said that, there's quite a bit in the pipeline. So ABB is executing a fairly large transformer order. And you've got 765 kV transformers being executed pretty much by all the big players. But we don't see the pace of that being as high as it was in the last 5 years. It will start falling off at this stage. But it will be more than compensated in terms of the total business out there by, the other electrification that's going to come up.
Sure. But in terms of profitability, as you said, copper conductors is somewhere in between HEC and the traditional conductors. So, I mean, going forward, what is the kind of, optimum profitability we can look at with the current mix or potential mix?
With the potential mix, we are trying to target 12,000 a ton.
Okay. Fair enough. And just lastly, copper conductors, if you can just highlight what is the kind of opportunity we have and, our positioning in that space.
So for the next 5 years or so, we see a lot of electrification happening. They are converting all the diesel system to the electric system. A lot of new tracks are being put in place. There's some 35,000 crore rupees of investment in the railway segment. And in terms of the copper conductors, it translates to close to 25,000 tons per annum requirement. So we see this as a steady demand in the next few years because traditionally in India, the EPC and the other supporting players have been doing hardly 1/5 of whatever the current goals are of the government. So there will be a fair amount of demand in the next few years. Plus our business, we would like to do export also. So we, after sort of getting ourselves established in the local market, we will also start exporting. So again, there is a huge demand outside India for the railways. It's just that we have to get moving in that direction too. So there's some efforts being made by us on that.
All right, thank you.
Thank you. The next question is from the line of Anand Jain, an individual investor. Please go ahead.
Thanks for the opportunity, sir. The first question is, again, I think it must be a repeat question, but still, like, if I were to look at our EBITDA and PAT margins, they are at historical lows at this point of time. So, can there be a normalized assessment of what the margins would be over maybe next 2-3 years, which should, what one should anticipate? some kind of normalization there?
So, other than the cable business, the our oil segment and conductor segment is difficult to talk about as a percentage of. So, that's why you always hear something on a per ton or a per KL basis. So, our target is to get the conductor business to 12,000 per ton, and our oil business to cross 5,000 per KL. So that's what the target is. The product mix which we are targeting is capable of supporting that. And so, that's what our endeavor would be as we, move into 2020 to get, as close to that number as possible. And on the cable side, we are at double digit. We've crossed the 10% now, on a steady basis. This year we expect, as I mentioned earlier, to be between 10.25 and 10.5. And as we get into 2020, we are looking at a revenue of 2,000 crores and, delivering a 10+%, EBITDA.
Okay. So the next question is, if I remember around 2 conf calls back, you said that one of our competitors was going out of business because of very aggressive pricing. Has that happened?
Yeah.
Has that Hello?
Yeah. So, one of them has gone out of business. The other one is not taking on new business, but they are completing some of the orders on hand.
But that would also imply that the margin should increase because of lesser amount of competition, I would assume, and that has not happened.
So there has been, if you look at the addressable demand which is out there, that also has not been growing, and there has been a change in the composition as we've been talking, on this call, where you've had, traditional 765 kV and 800 kV where the tonnage is very high. So, in one shot you end up actually executing, large tonnage. That's moving into a much more distributed mode where you have, 132 kV and 220 kV. But the volume that finally comes up of that will pretty much compensate for the 765 kV. So, you're in a period where the change is actually taking place. Now, we have one business, as you can see from the order book. The copper side is up, even the conventional conductor side is up, particularly from the export side. So, the domestic side is a bit soft, but as far as Apar is concerned, we are not really worried because the export side actually and what's coming in from the non-conventional energy side will compensate for any drops that are there on the conventional, the conventional 765 kV, 800 kV market.
The next question is it fair to assume that Savita Oil Technologies is one of our competitors on the oil side?
Yeah, they are main competitor for our transformer oil, white oils, and also
but
they have a range of
But the margin profile of Savita Oil is far better than ours. Is there kind of a significant product difference? Is what I wanted to understand. And if yes, then it makes sense. Otherwise, I think they are kind of operating at 10% PBT margin in their business. If you go, I was just interested in why is this kind of difference?
So, I don't want to get into talking about, specifics with respect to a competitor. So there is, fundamentally, they have a similar product mix as us. They have a fundamentally different hedging policy. So, you may have some periods where, with the volatility that's happening in the foreign exchange, they handle it differently. We take plain vanilla forward covers. And so typically, if you take range forwards or you take any of these things where the upsides are open, like what has happened in the last quarter, you may see a sudden, sort of boost taking place. But if you take a historical view of the last 4 or 5 years, our product mix has actually been richer than theirs. Where we've had a penalty right now is that, the Hamria plant which has come up, there's an additional overhead from the plant. And the volumes from there have not actually fully played out because the Middle East, the GCC and the African region is a bit subdued in terms of, as I mentioned in the very first paragraph of today's comments, that market has been subdued. Like Saudi Arabian market is down 50%. Iran, which can actually be serviced very well from there, is under sanctions. And most of the African countries, the buyers are rich and have the money to purchase, but the country doesn't have adequate, foreign exchange. So because of that, the profitability expected coming out of the Hamria facility is a lot lower than what had been planned. Also, the automotive business, the nature of our business may be different than theirs. So, when you have a more steady state sort of situation, then the actual numbers start, showing up.
Makes sense. Last question is on HEC. I mean, the reason I'm asking this question is that at the end of Q2, our guidance for HEC was 15%. And then in this quarter, we did only 8%. I mean, when you say that, and up to Q2, we did around 10 to 11%. I think 11% is what we did. So the assumption was that the next 2 quarters, we'll be doing around 20% in HEC to meet 15% guidance for the whole FY19.
So actually what happened in case of HEC, even the orders which were on hand didn't get executed actually. Because as explained earlier on the call actually, because you have to get the outages actually, and during this election period, they may not like to give the outage. Plus the orders which were open actually, I mean those tenders which were open, they were also not finalized.
There is a huge amount of latent demand. It's running in hundreds of crores, including tenders which have opened but not awarded, and tenders which have been published but not opened, So that's the reason why, this particular quarter, even last quarter, has been lower than what we had originally, envisaged. But come 2020, I don't think there's, being in the industry, we can see that the lines are running at dangerously high levels of utilization. So it's a matter of time before which, come election or no election, you'll have to do something about it. And the lines have been identified, the technology has been identified, it's an execution issue from the government side. So our sense is that 2020 will see a slightly different picture on this HEC front.
Last question is on the cable side. So now if one tracks the cable companies, most of the cable companies, what has happened over a period of time is that all of them have had great demand. And we can clearly see the numbers and everything, and there's a significant capacity expansion happening all through the industry. So do you see some kind of an excess capacity developing in that segment?
So, the power cable side is described by whatever you have said, where people have put in a lot of capacity or have started adding capacity. The real bottleneck in the cable business today is access to working capital. So it's not a question of how much physical capacity you have, but how much business you can do, given the fact that it's difficult to access, increased borrowings from banks, etc. The power cable side has always remained competitive. Our margins have improved not because selling prices have improved, but because of economies of scale. As the production has got larger and the productivity which we've been able to drive. The main difference that has come from, the elastomeric and the OFC side, where the margins are intrinsically higher, and that has contributed a larger portion of the pie. Now, in terms of the elastomeric side, it's not a question of just putting in cabling capacity, because we do our own compounding. So you've also got to have, the compounding capability, and then, have approvals from customers. It's a lot more involved and a difficult process compared to, on the power cable side, where the product mix is relatively straightforward. So I don't see that impact coming in and hitting our cable business, for at least the foreseeable future.
Okay, great. That answers my question. Thanks a lot.
Yeah, thank you.
Thank you. The next question is from the line of Lala Ram Singh from Vibrant Securities. Please go ahead.
Good evening, gentlemen. My question is on the elastomeric cable. You said that you have seen good demand from renewables, especially wind. However, based on reading of industry articles, it seems that the execution have not been in line with the biddings which have happened. So, what is your take on that? Are the executions picking up on the ground?
So, in this financial year, the contribution which has come from wind is still very small.
It has only started picking up in the last few months. And some of the key customers that we have, they have got orders and have started executing, the supply of the windmills. So if you see, this year we've done a little over 40 crores in revenues for the windmill sector, which was in line with what was there in the last year. Only difference is that in the last year, all of that revenue came in the first quarter, and then everything shut down pretty much. Now the business has just started reviving. So we've seen, increased order booking that's come from Suzlon, from Gamesa. Even some of Inox projects have started taking off, where customers in some cases are actually, picking up the cables and ordering them on a direct basis. So across the board, we are seeing that the windmill side has started picking up.
Okay. And within the segment, with whom do we compete? The competitors within elastomeric cables?
So the main competitor that we have is Universal Cables of Satna.
Okay.
And then to a smaller extent, there's KEI and a few others depending on the sizes of the cables involved. But by far, we are the dominant player on the wind side in the country. We have over 60% share in this.
Got it. And this business also works on a tender basis?
Well, the windmill supplier would probably, it's either tender or negotiated, because finally there's an EPC player or a utility that bids on, the power tariff. Then that translates into an order that's been placed on one of the windmill companies, and we are basically supplying the cables which actually go into the windmill.
Got it.
So ours is a pure negotiated deal. There's no tender that we have with our customers.
Okay. The last question is on the conductor side. You said that there was an impact of around 350 to 400 rupees per ton because of the lack of availability of grid power. So after adjusting for that, still our EBITDA per ton is say below 9,000 per metric ton, which is on a, if you compare with the first quarter of this year and even second quarter, is much below that. So are there any other reasons also which are responsible for the drop apart from the product mix and this power availability?
See, one is the product mix, as you said. Actually, HEC is 8% as against that. Last year it was much higher actually. It went as high as 13%. But there is a cost impact in case of furnace oil also. Because of the oil price increasing, the furnace oil impact is about 460 rupees per ton. And there is an impact on steel also, which we have said in our investor update also. That is about 430 rupees per ton. This is for 9 months. This is not for the quarter actually, the entire 9 months.
Okay. So could you give us some commentary on the current situation of raw material across your different business segments, be it copper, steel, aluminium and oil?
So, as far as copper and aluminum is concerned, they are both hedgeable commodities.
Okay.
So in that we manage the volatility or the movements up or down by actually taking back-to-back positions on LME. This impact has come from steel, which is not hedgeable, and then the higher consumption of furnace oil as well as diesel because of the lack of this electrical connectivity that's there. So that issue has got sorted out. As I said, generally 2020 we see a more benign environment in terms of impact on these products or from these factors.
Okay. Also on the interest cost, I think although on a YY basis there is an increase, but sequentially this time we have shown an improvement.
Correct.
Which is a very good sign. So should we expect the interest cost to stabilize at this quarterly run rate going forward?
Generally, it will stabilize, but it will also be driven by revenue. Suppose tomorrow, if the revenue increases, then the interest cost is going to increase.
Of course, ignoring that proportional.
It will be in line with the revenue, percentage-wise.
Okay, that's it. Thanks a lot and all the best.
Thank you.
Thank you. Ladies and gentlemen, that is the last question. I now hand the conference over to the management for their closing comments.
Yeah. Thank you very much for being on our call, and
patiently sitting through the Q&A. So thank you very much. Goodbye.